Two growth stocks with real moats and real momentum. One dominates performance footwear and lifestyle. The other built the pet care subscription engine millions rely on. Let's get you ahead of the curve. These are leaders in their lanes, not hype plays. A brand machine loved by athletes and trendsetters, and a pioneer of recurring e-commerce revenue. If you want long-term compounding, you want businesses with pricing power, loyalty, and predictability. We'll unpack strengths, recent performance, and the long game behind why these names could keep winning. Company 1 is a titan in performance footwear and premium lifestyle with fierce customer devotion. Company 2 is a pet care platform that turned replenishment into a habit through subscriptions. We're here for durable, decade-long stories, not the noise of next week. We'll assess the data, the trends, and the competitive edges that matter. Both operate in massive markets and connect deeply with their customers. Like, share, and subscribe so you don't miss the next major update. First up, the footwear and lifestyle powerhouse you've seen everywhere. We'll see why brand equity and execution can beat headwinds. Remember, the goal isn't to chase heat, it's to own quality, let it compound, and stay patient. Let's pull back the curtain. Deckers Outdoor, ticker DECK, is the parent behind iconic names like Hoka and UGG. Hoka wins with serious runners and comfort-first walkers through performance and cushioning. UGG evolved from a niche boot into a year-round lifestyle brand with massive appeal. Brand power here is an economic moat, loyalty, pricing power, and repeat purchases. This is a well-managed global operator, not just a fashionable label. Clear brand identities let Deckers play offense across different audiences. Diversification adds stability if one trend cools and another heats up. Premium positioning sustains margin strength and desirability. The market's narrative diverged from the business's reality during retail headwinds. That disconnect can be an opening for patient investors. Hoka and UGG turn buyers into fans. That's repeat behavior with pricing power. Brand equity translates into financial resilience when it counts. Deckers has consistently topped revenue and EPS expectations across recent quarters. Execution and supply chain discipline show up in results. Strong brands plus clear playbooks create room for multi-year compounding. Let's quantify the thesis, guidance, growth, and valuation signals. Despite consumer softness, management's guidance called for roughly $5.0 billion in revenue and over $960 million in net income. Those are the hallmarks of a healthy, growing business. Some projections point to $6.5 billion revenue and $1.1 billion earnings by 2028. That implies about 8.5% annual revenue growth. Achievable given brand momentum. Hoka's worldwide momentum is a powerful tailwind. UGG's enduring appeal adds ballast through cycles. In 2025, shares fell sharply, down about 53% year-to-date, at one point. That reset pushed the PE near 14, unusually low for this caliber of brand portfolio. The driver was broad U.S. consumer weakness hitting many apparel peers. When sentiment overshoots to the downside, value opens up for long-term buyers. Risks, prolonged weak demand or fast fashion swings can pressure sales. Mitigant, seasoned brand stewardship and product innovation across cycles. Thesis, buy a leader temporarily out of favor, let execution and demand normalization play out. If targets are met and consumer spending stabilizes, a strong recovery is plausible. Right now, the company is valued at about $15.38 billion in market cap. It's trading at a price-to-earnings ratio of roughly 15.47, with earnings per share sitting around $6.73. In 2024, Deckers brought in about $4.28 billion in revenue and delivered net income of approximately $759.56 million. So you're looking at a business that's already producing meaningful profits with a valuation multiple that suggests the market is not pricing it like a high-flying growth stock, but more like a steady, established earner. Now let's shift to our second company with a different kind of moat. Subscriptions in pet care. Essential products, predictable reorders, and a platform built on loyalty. Chewy, ticker cHWY, transformed how pet parents buy food, meds, and essentials. It's more than retail, it's a service experience customers trust. Legendary support and personal touches foster deep loyalty. The core flywheel is Autoship. Schedule it, forget it, never run out. Recurring necessities create predictable, visible revenue for investors. Scale in logistics plus data insights expands wallet share over time. In a strong Q3, subscriptions comprised about 84% of revenue. Autoship grew roughly 13.6% year over year, outpacing total revenue growth of about 8%. That base is a powerful tailwind for consistency and margin leverage. Services like telehealth further embed Chewy in the pet wellness ecosystem. Cross-sell, higher margin private label, grooming supplies and pet insurance increase LTV. Late 2025, analysts and institutions accumulated shares, shifting sentiment positive. Forward PE near 28, slightly below the S&P 500 average, reflects growth plus improving margins. Scaling fulfillment and loyal subscribers drive efficiency and margin expansion. Chewy's market cap is around $13.36 billion, so it's in a similar size bracket, but the valuation story is very different. The stock is trading at a price-to-earnings ratio of about 65.71, with earnings per share of roughly 49 cents. In 2024, Chewy generated about $11.14 billion in revenue, but net income came in at only about $39.58 million. That tells you Chewy is operating at far thinner profitability despite its much larger revenue base, and the market is placing a far higher earnings multiple on it, which usually implies investors are betting on margin expansion and stronger profit growth ahead. As investors recognize the operational gains, a sustained recovery into 2026 becomes more likely. Quick word from our sponsor, then we'll compare both paths to dominance. This video is brought to you by Value Stocks Investing Master Course. If you want to grow wealth with solid, undervalued stocks but don't know where to start, I built this course for you. Learn to spot great businesses, make smarter calls, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course and take control of your financial future. Deckers is a branded goods powerhouse. Chewy is a digital platform with a subscription engine. Moats, brand equity, and pricing power versus convenience, service, and recurring revenue. Deckers sells desirability, Chewy sells peace of mind. Deckers levers, international expansion, product innovation, premium status. Chewy levers, LTV growth, services, data-driven cross-sell. Owning both diversifies within growth. Apparel and pet care respond to different cycles. Deckers is more cyclical. Chewy benefits from non-discretionary replenishment. Together, you blend premium brand, upside, with subscription predictability. Use valuation as context. Focus first on revenue growth, margins, and cash generation. For Chewy, a median target near $48 with many buys suggests constructive sentiment. For Deckers, watch execution against midterm revenue and earnings goals. Key metrics: Deck global sales, inventory, new launches, cHWY Autoship ads, retention, gross and net margins. Let's wrap with your next move and a quick invite. Want exclusive stock tips, in-depth analysis, real-time trade alerts, and free investing guides? Join the StocksGalore Patreon today. Members get full, in-depth analysis on most stocks we cover here. Head to patreon.com/StocksGalore and join a growing community of smart investors. Links in the description. After hearing both stories, which fits your strategy better, Deckers, Deck, or Chewy, cHWY, and why? Tell us the single most important metric you'd monitor first. Deckers' valuation and margin trajectory, or Chewy's Autoship growth and retention. Drop your thoughts below. I'll read and pin some of the sharpest takes for everyone to see. Deckers leverages premium brands and pricing power. Chewy rides recurring revenue in a resilient category. Different risks, clear drivers. Think in years, focus on business performance. Don't forget to like, share your thoughts in the comments, and subscribe so you don't miss the next important investing update. Turn on notifications to stay ahead of key moves. Thanks for watching. I appreciate your time. See you in the next one.